There is a moment in many professional lives when financial strain does not arrive through crisis, but through comfort. It emerges gradually, almost politely, wrapped in the appearance of progress. A salary increase arrives, perhaps accompanied by a modest celebration, a quiet sense of validation, and the reassuring belief that the difficult phase is now behind you. Yet over time, something subtle begins to change. The expenses that once felt occasional begin to feel necessary. The upgrades that once felt indulgent begin to feel reasonable. Without any single dramatic decision, the financial landscape quietly reshapes itself. The experience of becoming financially comfortable often carries an unexpected cost because comfort tends to recalibrate expectations faster than income recalibrates reality. When individuals first reach a level of stability where bills are manageable and discretionary spending becomes possible, the psychological system interprets this as a new baseline rather than a temporary improvement. What once felt like relief gradually transforms into an unspoken standard. This shift is not driven by irresponsibility or lack of discipline. It is driven by deeply embedded cognitive mechanisms designed to normalize the present environment in order to reduce emotional friction. From a behavioral economics perspective, this process reflects the principle of hedonic adaptation. Human perception is structured in such a way that improvements in conditions are absorbed into daily experience with remarkable efficiency. The new car loses its novelty. The upgraded apartment becomes simply home. The higher quality groceries become routine. As adaptation unfolds, the emotional boost that accompanied the initial upgrade fades, while the financial commitment remains fixed. This creates a structural asymmetry between psychological satisfaction, which declines over time, and financial obligation, which persists indefinitely. Mathematically, the cost of comfort becomes more visible when we examine the compounding nature of recurring lifestyle adjustments. A modest increase in monthly spending may appear insignificant when viewed in isolation. An additional $200 for convenience services, a slightly higher rent for improved location, incremental subscriptions that promise efficiency or entertainment. Each change feels individually rational, often supported by persuasive narratives about productivity, well-being, or deserved reward. However, when these increments accumulate, they reshape long-term financial trajectories in ways that are rarely perceived in the moment. Consider a scenario in which an individual increases recurring monthly expenses by $500 after receiving a salary adjustment. Over the course of a single year, this represents $6,000 redirected toward maintaining a new standard of living. Over a decade, without accounting for inflation or investment opportunity cost, the cumulative outflow exceeds $60,000. When viewed through the lens of potential capital growth, the implications become even more complex. The cost is not merely the direct expenditure, but the forfeited potential of what those funds might have become under different allocation strategies. This phenomenon is not limited to consumer behavior. It extends into housing decisions, transportation preferences, professional networking environments, and even social expectations. As individuals ascend into more financially comfortable circles, the reference points that shape acceptable spending evolve accordingly. Dining norms change. Travel patterns adjust. Gift-giving expectations expand. The economic ecosystem surrounding the individual begins to exert subtle pressures that redefine what is perceived as reasonable participation. The result is not extravagance in the traditional sense, but an increasingly expensive version of normal life. Historical financial patterns suggest that this dynamic has repeated across generations, though the specific expressions differ according to technological and cultural context. In the mid-20th century, rising suburban affluence was accompanied by the normalization of car ownership, home appliances, and larger residential spaces. In the late 20th and early 21st centuries, digital connectivity, global mobility, and experiential consumption have taken on similar roles. Each era introduces its own markers of comfort, and with them, new layers of ongoing financial commitment that gradually become invisible through familiarity. Psychologically, the transition from scarcity to comfort often triggers a protective instinct that can paradoxically reinforce higher spending. Having experienced periods of constraint, individuals may feel an implicit obligation to secure the present level of ease, even if doing so requires locking in long-term costs. This protective impulse can manifest in decisions that prioritize stability and perceived quality of life over flexibility. Fixed expenses increase, savings buffers shrink relative to obligations, and financial resilience becomes more sensitive to external disruptions. The mathematics of income progression adds another dimension to the cost of comfort. Salary growth typically occurs in increments that are subject to taxation, market volatility, and industry-specific ceilings. Lifestyle adjustments, by contrast, often occur in discrete jumps tied to life events such as relocation, career advancement, or family formation. This mismatch between gradual income scaling and stepwise expense escalation can create structural tension within personal financial systems. Over time, the margin between earnings and obligations may narrow rather than expand, despite outward signs of advancement. A systemic zoom-out reveals that the economy itself is structured in ways that monetize comfort. Entire industries are designed to identify moments of upward mobility and translate them into new consumption patterns. Financial institutions extend credit lines calibrated to anticipated income growth. Real estate markets segment neighborhoods according to aspirational signaling. Technology platforms optimize subscription models that align with rising discretionary budgets. These mechanisms are not inherently exploitative. They are functional components of modern economic ecosystems, yet they collectively contribute to the normalization of higher baseline spending. Behavioral research indicates that once individuals internalize a certain standard of living, the perceived psychological cost of downgrading often exceeds the financial benefit. This creates a form of lifestyle inertia. Even when objective analysis suggests that reducing certain expenses would enhance long-term stability, the emotional resistance associated with perceived regression can be substantial. Comfort becomes intertwined with identity, and financial decisions begin to reflect not only practical considerations but also self-concept and social positioning. The identity shift associated with financial comfort is particularly significant because it influences time horizons. Individuals who previously focused on short-term survival metrics may begin to adopt longer planning frameworks, yet the content of those frameworks is often shaped by the newly adopted lifestyle. Retirement projections assume the continuation of current standards. Career decisions prioritize roles that sustain or enhance comfort rather than those that maximize optionality. The future becomes anchored to the present baseline, reinforcing the structural commitment to existing expense patterns. In mathematical terms, the opportunity cost of maintaining comfort can be conceptualized as a divergence between potential and realized financial trajectories. If incremental income increases were allocated toward assets capable of compounding over extended periods, the resulting growth curves would differ markedly from those associated with elevated consumption. This does not imply that comfort is undesirable or that all lifestyle improvements should be deferred. Rather, it highlights the importance of recognizing that comfort is not a neutral state. It is an active financial position with measurable long-term implications. Economic history provides numerous examples of societies in which rising living standards produced both genuine improvements in well-being and new forms of financial vulnerability. The expansion of consumer credit in the late 20th century, for instance, enabled broader access to goods and services that were once considered luxuries. At the same time, it introduced systemic exposure to interest rate fluctuations and debt cycles that reshaped household balance sheets. Comfort, in this context, functioned simultaneously as progress and as a source of structural risk. A calm examination of personal financial systems often reveals that the true expense of comfort lies less in visible purchases and more in the quiet accumulation of fixed commitments. Recurring payments, long-term contracts, and socially embedded expectations form an interconnected web that defines the cost structure of everyday life. Because these elements evolve gradually, they rarely trigger the urgency associated with sudden financial shocks. Instead, they produce a slow tightening of flexibility, a subtle reduction in the range of choices available under changing circumstances. Understanding why being comfortable is so expensive requires moving beyond moral narratives about discipline or indulgence and toward a systems-oriented perspective. Financial outcomes are shaped by the interaction of psychology, mathematics, social context, and historical forces. Comfort occupies a central position within this interaction because it alters perception, recalibrates norms, and influences the allocation of resources across time. Recognizing this dynamic does not demand the rejection of comfort. It invites a more deliberate awareness of the trade-offs embedded within seemingly ordinary decisions. The closing insight is not a warning against progress, but an invitation to observe the structural nature of financial life. Comfort, when examined closely, reveals itself as both a reward for past effort and a framework that shapes future possibilities. By approaching it with analytical clarity rather than emotional assumption, individuals can better understand how everyday choices contribute to long-term financial patterns. In this way, the true cost of comfort becomes not merely a figure in a budget, but a lens through which the mechanics of modern economic existence can be more fully understood.
Hi, we hope you enjoyed this video. If this discussion offered you a new lens on money and the quiet systems shaping financial life, consider liking the video and subscribing for more thoughtful insights. Your support helps this channel continue exploring the deeper patterns behind income, comfort, and long-term financial stability in an increasingly complex economic world.